Before we dive in, please remember that this video is for educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided here is not a substitute for professional advice tailored to your individual situation. Always consult with a qualified professional before making any financial decisions regarding your insurance coverage. Imagine this for a second. You're backing out of a tight spot at the grocery store. You're going slow, you're checking your mirrors, but then, crunch, a sinking feeling hits your stomach. You get out and see you've backed right into the door of a brand new Lexus. The owner comes out and thankfully nobody's hurt. You exchange information, you call your insurance company and you think, it's okay, I have full coverage, I'm protected. A week later you get a call. Your insurance is paying to fix the Lexus, no problem. But the $2,000 dent in your own car? That's on you. You're told your policy doesn't actually cover damage to your own vehicle in this situation. Suddenly, full coverage doesn't feel very full at all. You've been paying hundreds of dollars every year for a safety net that has a giant $2,000 hole in it. That scenario isn't just a bad dream. It's a reality for millions of Americans who believe in the single biggest myth in the auto insurance industry. And that myth is the term full coverage. Let me be perfectly clear. Full coverage is not a real insurance policy. It does not exist. It's a marketing phrase, a piece of industry slang that has been so overused that we've all accepted it as fact. And believing in this myth, not understanding what you're actually paying for, is the fastest way to find yourself financially ruined after an accident. This is why you're here. Because you've probably wondered, am I paying too much? Do I have the right protection? What does any of this even mean? In this video, we are going to tear down that myth and build your understanding from the ground up. We are going to demystify the jargon, expose the hidden risks and common policies, and give you a simple, powerful framework to analyze your own needs. By the time this is over, you will know the precise difference between basic liability insurance and the bundle of coverages people call full coverage. You will be able to walk into a conversation with any insurance agent, ask the right questions, and build a policy that protects your car, your savings, and your future, without wasting a single penny on coverage you don't need. We're going to turn confusion into confidence. So let's start by killing the myth once and for all. When people say full coverage, what they're usually talking about is a policy that combines three core components. The first is liability coverage, the second is collision coverage, and the third is comprehensive coverage. That's it. It's not some magical, all-encompassing shield. It's just a bundle of separate coverages. And the foundation, the one piece of insurance that is legally required in nearly every state in America, is the first one, liability. Think of liability insurance as other people insurance. It has absolutely nothing to do with you, your injuries, or your car. Its only job is to pay for the damage you cause to other people and their property if an accident is your fault. You hit someone? Liability pays for their medical bills. You smash their bumper? Liability pays to fix their car. You swerve and take out a neighbor's prize-winning rose bushes and a mailbox? Liability pays for that too. It protects you from being sued into bankruptcy by the people you hit. It is the absolute, non-negotiable bedrock of any auto insurance policy. This is the third party, in the title of this video. It covers the third party, the person you hit. You are the first party, your insurance company is the second, and they are the third. Now, this is where things get critical because not all liability coverage is created equal. When you look at a policy, you'll see a series of numbers like 50/100/50. This looks like confusing code, but it's actually the most important part of your policy. Let's break it down. It's called a split limit, and each number represents a maximum dollar amount your insurance will pay. The first number is the bodily injury liability limit per person. Let's use our 50/100/50 example. That first 50 means your insurance will pay a maximum of $50,000 for any single person's medical bills in an accident that you cause. $50,000 might sound like a lot, but a single trip in an ambulance, a few hours in the ER, and one minor surgery can burn through that in a heartbeat. If you cause an accident that results in a serious long-term injury, that $50,000 will be gone before the first bill even arrives. The second number is the bodily injury liability limit per accident. That 100 in our 50/100/50 example means your insurer will pay a maximum of $100,000 total for the medical bills of everyone in the car you hit, combined. So if you hit a minivan with 4 people in it, and they all have injuries, your insurance has a total pot of $100,000 to split between them. But remember, the first number still applies. No single person can get more than 50,000. So you could have one person with 50,000 in bills, another with 30,000, and a third with 20,000. That adds up to 100,000, and your policy is maxed out. If a fourth person has 10,000 in bills, that's coming out of your pocket. The third number is the property damage liability limit per accident. The final 50 means your insurer will pay a maximum of $50,000 for any property you damage. This is mostly for the other person's car, but it also covers anything else you might hit: a fence, a light pole, a storefront. You might think 50,000 is plenty to cover a car. But look around you on the highway today. The average price of a new car is cresting $50,000. You tap the back of a new Ford F-150, a Tesla, or a BMW, and you can easily cause $20,000, $30,000, or $40,000 in damage. If you total that vehicle, you've just exhausted your entire property damage limit on one car. What if you caused a multi-car pileup? That $50,000 has to cover every single car you damaged. It evaporates instantly. Now here is the terrifying part. Every state has a legally required minimum amount of liability coverage you need to have. In some states, that minimum is as low as 25/50/25, or even less. Let's be blunt. Buying state minimum insurance is one of the most dangerous financial gambles you can possibly take. It is a statistical certainty that it will not be enough to cover a moderate to serious accident. Let's play out that 25/50/25 scenario. You cause an accident, and the other driver has a broken leg and some internal injuries. Their medical bills, after surgery and physical therapy, come to $90,000. Your policy has a limit of $25,000 per person. So your insurance company writes a check for $25,000 and then wishes you the best of luck. The other driver's attorney then comes after you personally for the remaining $65,000. They can garnish your wages. They can put a lien on your house. They can seize your savings account. Your financial life as you know it could be over, all because you tried to save a few dollars a month on your premium. And we haven't even talked about their car yet. If you totaled their $40,000 SUV, your $25,000 property damage limit means you are now personally on the hook for another $15,000. In one single accident, a state minimum policy has left you with an $80,000 bill that you are legally required to pay. This is why understanding liability is so crucial. It's not about fixing your car. It's about protecting your entire financial world from a lawsuit. So, if state minimums are a trap, how much do you actually need? The standard recommendation from most financial experts is to carry at least 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for all injuries in an accident, and 100,000 for property damage. For many people, especially those with significant assets to protect, like a house or a healthy retirement account, even that isn't enough. They often opt for 250/500/250, or even add a separate $1 million umbrella policy on top of that for ultimate protection. So the first step in choosing the right insurance is to look at your liability limits. Forget about your car for a moment. Think about what you have to lose. Your income, your savings, your home. Your liability coverage is the fortress wall you build around those assets. And choosing the state minimum is like building that wall out of cardboard. It's going to fall down the moment it's tested. You are paying for peace of mind and for the certainty that one bad day on the road doesn't turn into a decade of financial ruin. That covers the other guy. It's the mandatory foundational piece of your policy, but it does nothing for your own car. If you have a $10,000, $20,000, or $30,000 vehicle, you're still completely exposed. So how do you protect your own investment? That is where the other two pieces of the full coverage myth come in: collision and comprehensive. And the rules for who needs them and how much to pay for them are completely different. Let's start with collision. The name is pretty self-explanatory. It covers damage to your car when you collide with something else. That could be another car, or it could be a pole, a guardrail, a fire hydrant, you name it. If you are in control of the vehicle and you hit something, this is the coverage that fixes your car. Imagine you're driving your pride and joy, a 3-year-old SUV you've worked hard for, worth about $25,000. You're pulling out of a tight parking spot, you get distracted for just a second, and crunch! You've scraped the entire side of your vehicle against a concrete pillar. You get out, your heart sinks. The other car, the pillar, is perfectly fine, but your car has thousands of dollars in damage. If you only have liability insurance, you are on your own. Your insurance company will say, "Sorry, we only cover damage you do to others." You're now facing a $4,000 repair bill that you have to pay entirely out of your own pocket. For many people, that's a devastating, unexpected expense. But if you have collision coverage, the story changes. You call your insurance company, you file a claim, and they handle it. Now, it's not completely free. This is where a critical term comes into play: the deductible. Your deductible is the amount of money you have to pay out of pocket before the insurance company starts paying. Think of it as your share of the repair cost. Deductibles typically range from $250 to $2,000 or more. The most common are $500 and $1,000. So, in our pillar scenario, if you have a $500 deductible, you pay the body shop the first $500. Your insurance company then pays the remaining $3,500. If you have a $1,000 deductible, you pay the first $1,000, and the insurance company pays the remaining $3,000. Why would anyone choose a higher deductible? Simple. The more risk you're willing to take on yourself, the higher your deductible, the less your insurance company has to risk. And they reward you for that with a lower monthly or semi-annual premium. Choosing your deductible is a balancing act between what you can afford to pay every month versus what you could afford to pay in a lump sum if you have an accident. So, collision covers you when you hit something. But what about all the other ways a car can be damaged? What if a huge branch from an oak tree snaps off during a storm and crushes the roof of your car while it's parked in your driveway? What if you walk out of the mall to find your car is just gone, stolen from the parking lot? What if a deer decides to play chicken with you on a country road at dusk, and the deer loses? In all of those cases, you didn't collide with another vehicle due to your own driving. These are what the industry calls non-collision events. And this is where the second piece of the puzzle comes in: comprehensive coverage. Comprehensive is best understood as the everything else, or acts of God coverage. It's for the weird stuff. It protects your car from damage caused by things other than a collision. This includes theft, vandalism, fire, hail, flooding, falling objects, and hitting an animal. Let's be clear. Liability insurance does absolutely nothing for you in these situations. If your car is stolen and you only have liability, your insurance company will send you a sympathy card, but they won't send you a check. You are still responsible for any loan you might have on that stolen car, and you now have to buy a new one. It's a financial nightmare. But with comprehensive coverage, you're protected. Just like collision, it has a deductible. You pay your share first. Let's say it's $500, and the insurance company covers the rest, up to the actual cash value of your car. If that deer strike caused $6,000 in damage, you pay $500, they pay $5,500. If your $10,000 car is stolen and never recovered, you pay your deductible, and the insurance company cuts you a check for $9,500 so you can go car shopping. So now we can finally put the pieces together. When you hear a dealer or a friend or an agent talk about full coverage, what they are almost always talking about is a policy that bundles these three things together: liability insurance, which is for others, plus collision and comprehensive insurance, which are for you. It's not some special, all-inclusive, magical policy. It's just industry slang for a combination of these separate coverages. It's the difference between protecting everyone else on the road from your mistakes, and also protecting yourself from your own mistakes, and from the random chaos of the world. This brings us to the real heart of the matter. The million-dollar question, or in this case, the multi-thousand-dollar question: do you actually need full coverage? The answer isn't the same for everyone. It depends entirely on your specific financial situation. But we can break it down into two major scenarios. Scenario 1. You have a loan on your car. If you are leasing your vehicle or you have an auto loan from a bank or credit union, the decision has already been made for you. You are required to have both collision and comprehensive coverage. Period. It's not a suggestion. It's a non-negotiable part of your loan agreement. Why? Because until you pay off that loan, you don't truly own the car. The bank does. The legal document, the title, lists them as the lien holder. That car is their asset, their collateral for the money they lent you. They have a vested financial interest in making sure that car stays in one piece, or that its value can be recovered if it's destroyed. Think about it from their perspective. They lent you $30,000 for a new car. A year later, you still owe them $26,000. You cause an accident and the car is totaled. If you only had liability coverage, the car is now a worthless pile of metal. You're devastated, you're out of car, and you might just decide to stop making payments on a loan for a car that doesn't exist anymore. Now the bank is out $26,000 with no asset to repossess and sell to recoup their loss. They're not going to let that happen. So, they mandate that you carry collision and comprehensive for the entire life of the loan. This ensures that if the car is totaled or stolen, the insurance company will pay out the value of the vehicle. That money will go directly to the bank to pay off your loan, and their investment is protected. And you do not want to test them on this. If you try to save money by dropping collision and comprehensive from your policy while you still have a loan, your insurance company is legally obligated to notify your lien holder of the change. When the bank finds out, they will take out a policy on your behalf, called force-placed insurance, and they will add the exorbitant cost of that policy directly to your loan payment. This force-placed insurance is incredibly expensive, often 2 or 3 times what you would pay on your own, and it only protects the bank's interest, not yours. It is the worst of all worlds. So, if you have a loan, the answer is simple: you need full coverage. But what about scenario 2? What if you own your car outright? The loan is paid off. The title is in your name, free and clear, tucked away in a safe place. Now the choice is entirely yours. No one is forcing you to do anything beyond the state-required minimum liability. This is where the real strategy comes in. This is where you can make decisions that save you hundreds, even thousands of dollars a year. The decision to keep or drop collision and comprehensive coverage now hinges on a cold, hard financial calculation. It's a battle between 2 numbers: the guaranteed cost of the insurance premium versus the potential catastrophic cost of replacing your car. And figuring out the tipping point, that exact moment when paying for that extra protection stops making sense, is the key to mastering your auto insurance bill. So let's pull back the curtain on what full coverage actually is. Because I have to let you in on a little industry secret. There is no single insurance policy called full coverage. It doesn't exist. You can't call your agent and say, "Give me the full coverage policy." It's a marketing term, a convenient piece of shorthand we all use to describe a bundle of different coverages. It's like ordering a combo meal at a fast food restaurant. You don't just get a combo, you get a burger, fries, and a drink. Full coverage is the same idea. It's a package deal, and the main ingredients, the burger and fries of the insurance world, are 2 distinct types of protection: collision coverage and comprehensive coverage. These 2 are the heart and soul of protecting your own vehicle. Remember how in the last part we talked exclusively about liability insurance, which pays for damage you cause to other people and their property? Well, collision and comprehensive are the mirror image. They are all about paying for damage to your car. This is the fundamental difference, and it's why the cost skyrockets. You're no longer just protecting yourself from a lawsuit. You're protecting the physical, tangible, multi-thousand-dollar asset sitting in your driveway. Let's start with the big one: collision coverage. The name is pretty self-explanatory, but the devil is in the details. Collision insurance covers damage to your car when you, collide with something. This could be another car, whether it's your fault or not. But it also covers collisions with inanimate objects. Back into a light pole in a parking garage? That's a collision claim. Take a corner too sharp and scrape your side against a concrete pillar? Collision. Swerve to miss a dog and hit a guardrail? Collision. Even flipping your car in an accident is considered a collision. It is the coverage that fixes or replaces your car after the classic, quintessential car crash. Now, here's the most important part of how collision coverage works: the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. Think of it like a copay at the doctor's office. You pay the first part and they handle the rest. Deductibles typically range from $250 to as high as $2,000 or more. And this is the first major lever you can pull to control your insurance costs. The rule is simple. A higher deductible means a lower premium. A lower deductible means a higher premium. Let's make it real. Imagine you're backing out of a tight spot at the grocery store. You're craning your neck, you check your camera, but you just don't see that rogue shopping cart someone left in the middle of the lane. Crunch. You get out, and there's a nasty dent and a long, deep scratch across your rear bumper. You take it to the body shop, and they quote you $3,000 for the repair. Now, let's say you chose a $1,000 deductible on your collision coverage to keep your monthly payments down. In this scenario, you would write a check for $1,000 to the body shop. Your insurance company would then step in and pay the remaining $2,000. If you had chosen a $500 deductible, you'd pay $500, and they'd pay $2,500. But your monthly premium for that policy would have been higher. Choosing a deductible is a calculated risk. You're betting on yourself. You're saying, "I'm willing to risk paying this much out of pocket in exchange for a lower bill every month." So that's collision. It's for the crashes, the impacts, the screw-ups. But what about everything else? What about all the chaos the world can throw at your car that has nothing to do with you hitting something? That's where the second piece of the full coverage puzzle comes in. Comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from a whole laundry list of unfortunate events that are generally outside of your control. This is your protection against the random, the weird, and the acts of nature. A tree branch falls on your car during a windstorm? That's a comprehensive claim. A massive hailstorm rolls through and turns your car's hood into a golf ball? Comprehensive. You're driving down a country road at dusk and a deer decides to leap in front of you? Believe it or not, hitting an animal is almost always a comprehensive claim, not a collision one. And it goes further. Comprehensive covers your car if it's stolen. It covers damage from vandalism, someone keying your car or smashing a window. It covers fire, floods, earthquakes, and riots. It's the life happens policy. It's the part of your insurance that acknowledges your car exists in a world full of falling objects, bad weather, and malicious people. Just like collision coverage, comprehensive coverage also has a deductible. It works the exact same way. If a tree limb causes $2,000 in damage and you have a $500 comprehensive deductible, you pay the first $500, and the insurance company covers the remaining $1,500. And here's a pro tip. Your collision deductible and your comprehensive deductible don't have to be the same amount. Many people opt for a lower deductible on comprehensive because the claims are often less frequent, but can be just as severe, and the cost to lower that specific deductible is often surprisingly small. So, when you hear someone say they have full coverage, what they really mean is that they have a policy that includes liability plus collision plus comprehensive. Liability protects other people. Collision and comprehensive protect you. They are the two pillars that hold up the promise of getting your own car fixed or replaced. Now you might be thinking, okay, I get it, but why is it sometimes not a choice? Why did my car dealer or my bank force me to get it? That is a fantastic question, and the answer reveals the true nature of car ownership. If you have a loan on your car or if you're leasing it, you don't technically own it outright. The bank or the finance company does. You're just making payments for the right to drive it. And because it's their asset, their multi-thousand-dollar investment, they want to make damn sure it's protected. They're not going to let you drive their $25,000 car off the lot with only liability insurance. Because if you get into an accident and total the car, they know you probably can't just write them a check for the remaining balance. They would be out a huge amount of money. So they mandate that you carry both collision and comprehensive coverage until the loan is paid off. They are protecting their investment. Once you make that final car payment and the bank sends you the title, the car is 100% yours. At that moment, the decision to keep collision and comprehensive coverage becomes entirely up to you. You are now your own bank, and you have to decide if protecting your own asset is worth the monthly cost. And that brings us right back to the central question. You now understand that full coverage is really a bundle of protection for your own car, built on the foundation of collision and comprehensive. You know it's designed to fix or replace your vehicle, whether you hit a pole or a deer hits you. But knowing what it is only half the battle. The critical part is knowing when to let it go. How do you decide when your car's value has dropped so much that you're essentially just lighting money on fire every month by paying for a level of protection you no longer need? How do you run the numbers for your specific car, your specific financial situation, and make the cold, hard, calculated decision that will save you hundreds, maybe even thousands of dollars a year? That calculation, that formula for financial freedom from your insurance bill, is what we're breaking down next. Alright, let's pull back the curtain. The core of this decision, the entire framework, rests on a simple but powerful financial guideline known in the money world as the 10% rule. It's not a law, it's not an unbreakable command from the insurance gods, but it is the single best starting point for 99% of people trying to make this choice. And it's shockingly simple. The rule is this. If the annual cost of your full coverage, that's just the collision and comprehensive parts, is more than 10% of your car's current value, it's very likely time to drop it. That's it. That's the rule. But knowing the rule and knowing how to apply it are two different worlds. So let's get our hands dirty and run the numbers together. First, and most importantly, you need to find your car's actual cash value, or ACV. This is the single most critical number in the entire equation. The ACV is not what you paid for the car. It's not what you think it's worth. It's what the car is worth in the open market right now, today. It's what an insurance company would actually write you a check for if your car was totaled, minus your deductible, of course. So how do you find this magic number? It's easier than you think. Go to websites like Kelley Blue Book, kbb.com, or edmunds.com. Punch in your car's year, make, model, trim, and be brutally honest about its condition. Don't click excellent if you've got door dings, stained seats, and the check engine light has been on since last summer. Choose the private party sale value, as that's a good proxy for its real-world worth. For an even more accurate picture, go to AutoTrader or even Facebook Marketplace, search for your exact car with similar mileage in your area, and see what they are actually selling for. Let's use an example. Say you have a 2015 Honda Accord with 120,000 miles. You do your research and you find its ACV is right around $8,000. Great. Step 1 is done. Step 2 is the easiest math you'll do all day. Take that ACV and calculate 10% of it. For our $8,000 Honda, 10% is $800. Write that number down. Circle it. This is your threshold. This is the line in the sand. $800. Now for step 3, and this is where most people get tripped up. You need to figure out the true annual cost of your full coverage. People look at their insurance bill and say, okay, I pay $2,000 a year for insurance. But that entire amount is not the cost of full coverage. A huge chunk of that is for your liability insurance, the part that's legally required. What you need to find is the specific cost of just the collision and comprehensive policies. The easiest way to do this is to call your insurance agent or log into your online portal and ask for a new quote for your exact same policy, but with collision and comprehensive removed. Let's say your current policy with full coverage is $150 a month, which is $1,800 a year. Then you get the quote for liability only, and it's $83 a month or about $1,000 a year. The difference between those two numbers is the true cost of your full coverage. In this case, $1,800 minus $1,000 is $800 a year. That is the money you are paying only for the option to have your own car fixed or replaced. Now we have our two numbers. The 10% threshold was $800. The actual cost of our full coverage is also $800. They're a perfect match. So what do? According to the 10% rule, you're right on the edge. You could probably justify keeping it or dropping it. But wait, we've missed one crucial expensive detail. The one thing that tilts the scales dramatically: your deductible. Remember, if your $8,000 car gets totaled, the insurance company doesn't just hand you an $8,000 check. They hand you a check for the ACV minus your deductible. If you have a common $1,000 deductible, your actual payout would be $7,000. That's the real amount of money you're protecting. So, a smarter way to use the 10% rule is to calculate 10% of your ACV minus your deductible. So, for our Honda, that's $8,000 minus $1,000, which is $7,000. 10% of $7,000 is $700. Now let's look at our numbers again. Our new smarter threshold is $700. The annual cost of our full coverage is still $800. And just like that, the decision becomes crystal clear. You are paying $800 a year to protect a potential $7,000 payout. The math is telling you, screaming at you, that this may no longer be a good deal. You're paying more than 10% of the potential benefit. Over 5 years, you would have paid $4,000 in premiums to protect a car that might only be worth $5,000 by then. You're in a race against depreciation, and it's a race you will always lose. The numbers are a powerful guide, but they only tell half the story. The other half isn't about math. It's about your peace of mind and your personal financial reality. This is what I call the sleep at night factor. Dropping full coverage is an act of self-insurance. You are consciously firing your insurance company from the job of protecting your car's value, and you are hiring yourself to do that job instead. So the most important question you have to ask is this: if I walked outside tomorrow and my car was gone, stolen, totaled in a hit and run, crushed by a falling tree, could I handle that financial hit without it completely derailing my life? Do I have enough in savings to go out and buy another car to get to work on Monday? If the answer is a resounding no, then you might need to keep full coverage for a while longer, even if the math says to drop it. It becomes a necessary evil, a cost you pay for the stability to keep your life running. But if you have a solid emergency fund, say 3 to 6 months of living expenses saved up, and you could absorb the cost of buying another $8,000 car, then you are a prime candidate to self-insure. And this brings us to the most powerful part of this strategy. If you decide to drop full coverage, you cannot, I repeat, you cannot just absorb that savings back into your lifestyle. Don't just let that extra $80, $90, $100 a month get eaten up by extra lattes and takeout. That defeats the entire purpose. Instead, you must be disciplined. You take the exact amount you were saving in our example, that $800 a year, or about $67 a month, and you set up an automatic transfer from your checking account into a separate high-yield savings account that you label Car Replacement Fund. You are now officially paying yourself instead of the insurance company. You are building your own personal insurance policy. In 1 year, you'll have over $800. In 3 years, you'll have nearly $2,500 plus interest. In 5 years, you'll have over $4,000. That money is your safety net. It's the fund you'll tap if something happens to your car. And if nothing happens, that money is yours to keep, to invest, to use for a down payment on your next better car. You've taken the profits the insurance company would have made and put them directly into your own pocket. This is how you shift from being a passive consumer of a financial product to an active manager of your own financial risk. It's a fundamental change in mindset from, "What if I lose my car?" to, "How will I prepare for when I need a new car?" But this calculation, this decision to self-insure, is deeply personal, and it depends on more than just the value of your car. It depends on you. And when we say it depends on you, we're not talking about your driving record or the color of your car. We're talking about the financial foundation you've built for yourself. We're talking about your personal tolerance for risk and your ability to weather a financial storm. Think of your financial life like a fortress. The walls of this fortress are your savings, your investments, and your income streams. Inside those walls are all the things you value: your family, your home, your future. Every financial decision you make either strengthens those walls or leaves a crack in the foundation. Auto insurance is just one of those decisions, but it's a powerful one. Choosing to drop comprehensive and collision coverage is like deciding to man a section of that wall yourself, instead of paying a mercenary, the insurance company, to stand guard for you. This can be a brilliant strategic move, saving you money and giving you more control. But if you send that mercenary away before you've built the wall high enough, you're not being strategic. You're just leaving a gaping hole for disaster to march right through. The single most important stone in that wall is your emergency fund. And let's be brutally clear about what an emergency fund is and what it isn't. It is not your credit card limit. It is not the money you're vaguely planning to save next month. It is not your 401k that you could technically borrow from. An emergency fund is a dedicated liquid cash account, usually a high-yield savings account, that is boring, untouchable, and exists for one reason only: to save your life when everything goes wrong. This isn't just your car is totaled fund. This is your, "I just lost my job and the roof is leaking" fund. It's your "my kid broke their arm and the insurance deductible is a nightmare" fund. The standard advice is to have 3 to 6 months of essential living expenses saved. Not 3 to 6 months of your salary. 3 to 6 months of what it actually costs you to live. That means rent or mortgage, utilities, food, gas, debt payments, the absolute bare-bones budget to keep your life afloat. Why is this non-negotiable when considering dropping full coverage? Because without that fund, you are not self-insuring. You are simply uninsured. You're gambling. You're closing your eyes, crossing your fingers, and hoping you don't get into an accident. Self-insuring is an active strategy. It's a conscious decision, backed by a robust financial plan, to absorb a potential loss yourself because you've calculated that it's cheaper in the long run than paying an insurance company to absorb it for you. If you have a $2,000 car and a $10,000 emergency fund, you are in a position to self-insure. If you have a $2,000 car and $200 in your checking account, you are not. In that scenario, paying for full coverage isn't a waste of money. It's a lifeline. It's the expensive, imperfect, but necessary bridge that gets you to work every day until you can build that fortress wall high enough to protect yourself. Let's make this real. Imagine two people, Sarah and Mike. They both work at the same company, make the same salary, and drive the exact same 2012 Honda Accord, worth about $6,000. On paper, their insurance decision should be identical, but it's not. Sarah has spent the last 3 years diligently building her financial fortress. She has zero credit card debt and a $15,000 emergency fund sitting in a high-yield savings account. She looks at her $6,000 car and her insurance bill. The collision and comprehensive portion costs her $900 a year. She does the math. She's paying 15% of her car's value every single year just for the peace of mind that if she wrecks it, the insurance company will write her a check. But she realizes she doesn't need to buy that peace of mind anymore. She already owns it. Her $15,000 emergency fund is her peace of mind. If her car gets totaled tomorrow, it would be frustrating, but it wouldn't be a crisis. She could buy another $6,000 car with cash from her emergency fund and not even break a sweat. So Sarah drops full coverage. She takes that $900 she was sending to the insurance company and sets up an automatic transfer into a separate savings account she labels Future Car Fund. She is now self-insuring. Now look at Mike. Same job, same car, same salary. But Mike lives paycheck to paycheck. He has credit card debt, a small student loan payment, and maybe $1,000 in savings for a good month. For Mike, that $6,000 Honda isn't just a car. It's his entire economic mobility. It's the only way he can get to the job that pays for his apartment and his food. If his car gets totaled, it's a full-blown life-altering catastrophe. He doesn't have $6,000 to replace it. He'd have to drain his meager savings, go deeper into high-interest credit card debt, or maybe even take out a personal loan just to get back on the road. For Mike, that $900 a year payment for full coverage is not a strategic calculation. It's a survival tax. He is paying a premium to transfer the risk of a catastrophic loss to the insurance company because he simply cannot afford to bear that risk himself. Sarah and Mike have the same car, but they are living in two completely different financial worlds. The right insurance decision for one is the absolute wrong decision for the other. This brings us to a more subjective, but equally important factor: your personal risk tolerance. This is about your psychology. It's about what lets you sleep at night. Some people are natural risk takers. They are comfortable with uncertainty and trust in their ability to handle whatever comes their way. Other people are natural worriers. The very thought of a potential, unspecified loss keeps them up at night. There is no right or wrong personality type here, but you have to be honest with yourself about which one you are. If you have a $10,000 car and a $50,000 emergency fund, the math says you should probably drop full coverage. But if you know that every time you get behind the wheel, you'll be white-knuckling it, terrified of every deer, every pothole, every careless driver, then maybe that coverage is worth it. In this case, you're not really paying to insure your car. You're paying to insure your sanity. You are buying peace of mind. And peace of mind absolutely has value. The key is to make sure you're not overpaying for it, and that you're buying it for the right reasons, not just out of unexamined fear or a lack of financial planning. So how do you quantify this? How do you put a number on your own peace of mind? Ask yourself this one simple question: what is my sleep at night number? What is the maximum amount of money I could lose in a single unexpected event, like a totaled car, without it causing a major disruption to my life and my long-term financial goals? Be honest. Is it $1,000? $5,000? $10,000? This number is unique to you. It depends on your income, your savings, and your psychological makeup. Once you know your sleep at night number, the decision becomes incredibly clear. Look up the current private party value of your car on a site like Kelley Blue Book. If the value of your car is significantly below your sleep at night number, and you have at least that amount in your emergency fund, then dropping comprehensive and collision becomes a very logical, low-stress decision. You've pre-accepted the potential loss. You've made peace with it. You've built the walls of your fortress high enough that this particular threat no longer seems so scary. You've graduated from needing to pay someone else to carry that risk for you. But this is only half the equation. Because even if your car is worthless, and you're ready to let it go, there's another far more terrifying risk on the road. One that can't be measured by the value of your vehicle, and one that can utterly destroy the financial fortress you've worked so hard to build. This risk has nothing to do with dents or scratches. It has nothing to do with your Kelley Blue Book value. It has to do with the fundamental brutal physics of what a car is. A 2-ton metal box moving at high speed. It's a tool we use every day, but in the wrong circumstances, for one split second, it becomes a weapon. And the damage it can inflict, not on metal but on a human life, is the single greatest financial risk most of us will ever face. This is the world of liability. Liability coverage is the one part of your auto insurance that isn't for you at all. It's for everyone else. It's for the person you might hit. It's the component that is legally required in nearly every state, and for good reason. It's the absolute, non-negotiable bedrock of being a responsible driver, because it's a promise. It's a promise that if you make a mistake, if you cause an accident, you have the financial backing to help make the other person whole again. It's broken down into two main parts. First, there's property damage, or PD. This is the straightforward part. You hit someone's car, you damage their mailbox, you skid on ice and take out a storefront window. Your property damage coverage pays to repair or replace what you broke. The second part, and the one that carries infinitely more risk, is bodily injury, or BI. This is the coverage that pays for the medical expenses of anyone you injure in an accident. It also covers things you might not even think about, like their lost wages if they can't work, and the legal concept of pain and suffering. And this is where the value of your own car becomes completely, dangerously irrelevant. A 20-year-old beater that's worth less than an iPhone can crash into a brand new Mercedes, injuring its driver, and create a financial crater $500,000 deep. Your car is just the tool of destruction. The value of the destruction itself is what matters. To understand this, let's leave the world of abstract policy terms and tell a story. Let's meet David. David is a smart guy, a 45-year-old accountant. He's financially savvy. He has a 401k, a paid-for house, and a good savings account. He drives a 12-year-old Toyota Camry. It's got 150,000 miles on it, a few dings, and it's worth maybe $4,000. David looked at his insurance bill one day and thought, "Why am I paying so much for insurance on this old car? Full coverage is a waste." So he called his agent and dropped his collision and comprehensive coverage. To save even more money, he made sure he only had the state-mandated minimum liability coverage. In his state, that's 25/50/25. Let's quickly break that down. The first number, 25, means his insurance will pay out a maximum of $25,000 for bodily injury to a single person he hits. The second number, 50, means the total his insurance will pay for bodily injury for the entire accident is $50,000 no matter how many people are hurt. And the final number, 25, means he has $25,000 in coverage for property damage. David felt good about this. He was saving about $600 a year. He's a safe driver. What could possibly go wrong? One Tuesday afternoon, he's driving home from work. It's raining lightly. He stopped at a red light and his phone buzzes. It's a text from his wife. He glances down for just 2 seconds to read it. In that moment, his foot eases off the brake just enough for the Camry to roll forward, bumping the car in front of him at less than 5 miles per hour. It was the gentlest of fender benders. The car he hit was a brand new Audi Q7. The driver, a woman named Sarah, gets out. She's a successful graphic designer. There's a scratch on her bumper, but that's it. They exchange information. Sarah says her neck feels a little stiff, but she thinks she's fine. David's not worried. His old Camry has a new dent, but he doesn't care. He figures his $25,000 in property damage will more than cover a bumper scratch. A week later, the first call comes. It's from the Audi dealership's body shop. The estimate to repair the bumper is $11,000. David is shocked. The service manager explains that behind the plastic bumper cover are multiple parking sensors, a camera, and radar for the adaptive cruise control. They all have to be replaced and recalibrated. It's a complex, expensive job. Still, David thinks, okay, $11,000 is crazy, but my $25,000 limit covers it. No problem. 2 weeks later, the second call comes. This one is from a lawyer. Sarah's stiff neck didn't go away. It got worse. The doctor diagnosed her with a cervical strain, whiplash. She's been going to physical therapy 3 times a week. She's had an MRI. Her medical bills have already hit $19,000. David starts to get nervous. His limit for her injuries is $25,000. He's getting close to the edge, but he's still covered. He tells himself it will be okay. A month after that, a thick envelope arrives in the mail. It's a formal lawsuit. David's heart sinks as he reads it. Sarah's medical bills have now climbed to $35,000. His insurance company has already told him they will pay out their maximum of $25,000, but he is now personally on the hook for the remaining $10,000. David feels sick. $10,000 is a lot of money, a huge hit to his savings. But what he reads next is what truly terrifies him. The lawsuit isn't just for the extra $10,000 in medical bills. Sarah, being a graphic designer, works on a computer all day. The pain in her neck and the resulting headaches have made it impossible for her to stare at a screen for more than an hour at a time. She hasn't been able to work for 6 weeks. Her lost income is calculated at $15,000. The lawsuit demands that David pay for that too. So now he's on the hook for $10,000 in medical bills plus $15,000 in lost wages. That's $25,000 he has to pay out of his own pocket. But it gets worse. The final section of the lawsuit is for pain and suffering. Her lawyer is arguing that the chronic pain has diminished her quality of life. They are demanding an additional $150,000. Let's do the math on David's tiny 5-mile-per-hour mistake. The total claim against him is $11,000 for the car repair, $35,000 for medical bills, $15,000 for lost wages, $150,000 for pain and suffering. The grand total is $211,000. His insurance policy, the one he was so proud of for being so cheap, pays out its maximum limits. $11,000 for the property damage, since it's under the $25,000 limit, and $25,000 for the bodily injury. Total paid by insurance, $36,000. Total claim of $211,000 minus the $36,000. His insurance paid leaves a judgment against David for $175,000. That $600 a year he saved on his insurance premium has just cost him his entire financial future. The court orders his wages to be garnished. Every single paycheck, a large chunk of his money is automatically diverted to Sarah's lawyers until the $175,000 is paid off. They put a lien on his house. He can't sell it or refinance it without paying them first. They can legally drain his savings accounts. The financial fortress he spent 20 years building has been completely leveled by a 2-second distraction and an insurance policy that was designed to save a little cash instead of protecting a lifetime of work. David's story is not an exaggeration. It happens every single day across America. People driving around with minimum liability limits are financial time bombs, not just to others but to themselves. They mistakenly believe that because their car isn't worth much, they don't need much insurance. But as David learned, the value of your car has absolutely nothing to do with the value of the life you can alter in an instant. The real purpose of liability insurance isn't to comply with the law. It's to stand as a firewall between a simple mistake and absolute financial ruin. It is the single most important defense you have for everything you own and everything you will ever earn. So if that's the firewall protecting your future, what about the shield protecting your present? What protects the actual physical 1,000-pound machine you're driving every single day? This is where the entire conversation pivots from third-party liability to what is, without a doubt, the most misunderstood phrase in the entire insurance industry: full coverage. Let's be crystal clear about something right up front. There is no insurance policy you can buy called a full coverage policy. It doesn't exist. It's a slang term, a piece of industry jargon that's leaked into the public consciousness, and it causes a ton of confusion. Full coverage sounds like an invincible, all-encompassing force field for your car. It sounds like no matter what happens, you're covered. That is absolutely not the case. What people mean when they say full coverage is simply a policy that combines the state-required liability insurance with 2 additional, and critically important, types of coverage for your own vehicle. Those 2 coverages are collision and comprehensive. Think of it like a burger. Liability is the mandatory bun and patty. Collision and comprehensive are the lettuce, tomato, and cheese you choose to add on. Without them, you have a basic hamburger. With them, you have a deluxe cheeseburger. But nobody just sells you a plate of lettuce and cheese. They are additions to the main event. Let's start with collision coverage. The name is pretty self-explanatory. This coverage pays to repair or replace your car if it's damaged in a collision with another object. That object could be another car, a telephone pole, a guardrail, a fire hydrant, or even the wall of your own garage. The key thing to understand about collision coverage is that it pays out regardless of who is at fault. This is a monumental difference from liability. Remember, your liability insurance only pays for the damage you cause to other people. Let's say you're driving on a rainy night, you hydroplane, and you slam into a parked car. Your liability coverage will handle the repairs for the car you hit. But what about your own car, which now has a crumpled front end and a cracked engine block? Without collision coverage, you are 100% on your own. The bill for those repairs, or for a replacement vehicle if it's totaled, comes directly out of your pocket. Your liability insurer will wish you the best of luck, but they won't write you a check for a single penny. Collision coverage is the hero in that story. It's the part of your policy that says, okay, you messed up, or maybe you didn't, but your car is still wrecked. We'll take care of it. It's protection against your own mistakes or just plain bad luck. Now, this protection isn't free and it isn't infinite. It comes with something called a deductible. A deductible is the amount of money you have to pay out of pocket for a claim before the insurance company starts paying. They're universal in collision and comprehensive coverage. A common deductible is $500 or $1,000. So, if you have a $1,000 deductible and you cause an accident that results in $6,000 of damage to your car, you pay the first $1,000, and your insurance company pays the remaining $5,000. Think of it as your share of the cost. You're telling the insurance company, I'll handle the small stuff, but I need you to have my back on the big, catastrophic stuff. The second ingredient in the full coverage recipe is comprehensive coverage. This one is a little less intuitive, but it's just as important. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from a whole host of things that are, well, not a collision. This is the coverage for all the weird, random, and unfortunate events life throws at you. A hailstorm pummels your city and leaves your car looking like a golf ball? That's a comprehensive claim. You're driving down a country road at dusk, and a deer decides to reenact a scene from Bambi in front of your grill? Comprehensive. A massive branch from your neighbor's oak tree snaps off in a windstorm and crushes your roof? Comprehensive. Your car gets stolen from a movie theater parking lot? Comprehensive. Vandalism, fire, flooding, riots. All of this falls under the umbrella of comprehensive coverage. It's protection against the unpredictable. It's the universe is a chaotic place insurance. And just like collision, it also has a deductible. You choose the amount, and you pay that portion of the repair or replacement costs before your insurer steps in. So, when you bundle these two coverages, collision and comprehensive, on top of your basic liability, you get the package that people call full coverage. Liability protects everyone else from your financial impact. Collision and comprehensive protect you and your own vehicle from financial impact. At this point, you might be thinking, okay, that sounds great. It sounds like something everyone should have. Why is this even a choice? And the answer comes down to two things: cost and necessity. Adding collision and comprehensive can significantly increase your insurance premium, sometimes even doubling it, because the insurance company is now taking on a much greater risk. They're not just on the hook for a stranger's old minivan you might hit. They're on the hook for your brand new $40,000 SUV. And that brings us to the question of necessity. For millions of American drivers, having full coverage isn't a choice at all. It's a requirement. If you have a loan on your car or if you're leasing it, your lender, the bank or finance company, will mandate that you carry both collision and comprehensive coverage for the entire duration of the loan or lease. Why? It's simple. Until you make that very last payment, you don't fully own your car. The bank does. You're just the person they're letting drive it while you pay them back. That car is their asset, their collateral. They have a financial interest in it, and they are going to do everything in their power to protect that investment. Imagine you buy a new car with a $30,000 loan. You decide to save a few bucks by only getting liability insurance. 2 months later, you run a red light and your new car is totaled. You're okay, but the car is a worthless heap of metal. Your liability insurance pays to fix the other person's car, but you get nothing for your own. Here's the brutal reality. You no longer have a car, but you still have a $30,000 loan. You are legally obligated to keep making monthly payments to the bank for years, for a car that no longer exists. The bank knows this is a disaster scenario for them, because people in that situation are very likely to just stop paying. So, to prevent this, they force you to buy full coverage. That way, if the car is totaled, the insurance company will pay off the value of the car. The bank gets its money back, the loan is satisfied, and while you're still out of car, you're not buried under a mountain of phantom debt for an asset that's been turned into scrap metal. It's non-negotiable. If you have a loan, you have full coverage. Period. But what if you don't? What if you own your car outright? What if you drive a 10-year-old Honda that you paid for in cash? Now, for the first time, you have a real choice to make. You are the only person with a financial stake in that vehicle. The bank is out of the picture. The decision to shield that asset or not is entirely up to you. And this is where the math gets personal, and the right answer changes for every single person. It's a delicate balance between risk, value, and your own peace of mind. So let's put this into practice. Let's move beyond the abstract and meet 3 different drivers, each with a unique car, a unique financial situation, and a unique perspective on risk. We'll call them Sarah, David, and Maria. By walking through their decisions, you'll find the exact framework you need to make your own. First, meet Sarah. Sarah is a 28-year-old graphic designer who just bought a 2-year-old Honda CR-V for $27,000. She put $5,000 down and financed the remaining $22,000. Her car is her lifeline. She has a 45-minute commute to her office each way, every single day. It's her mobile office, her grocery getter, her weekend escape pod. Financially, she's doing okay. She has a few $1,000s in an emergency fund, but not $22,000. If her car were totaled tomorrow, she would be in a world of hurt. Not only would she have no way to get to work, but she would still owe the bank for a car that no longer exists. For Sarah, the choice between liability and full coverage is not a choice at all. It's a requirement. Her lender, the bank that gave her the auto loan, mandates that she carry both collision and comprehensive coverage for the life of the loan. Why? Because the bank technically owns the car until she pays it off. It's their asset on the line, and they are not going to let her risk it. They need to ensure that if the car is destroyed, their loan gets paid back. So she has full coverage. But let's imagine for a second that the lender didn't require it. Should she still get it? Absolutely. 100%. Her car's value is high, and her ability to replace it out of pocket is low. The risk of a total loss would be financially catastrophic for her. Paying an extra, say, $80 a month for full coverage is not just a fee. It's a shield protecting her from a $22,000 debt and a potential job loss. For Sarah, full coverage is non-negotiable. It's the cost of having a new financed vehicle that is essential to her daily life. Now let's meet David. David is 45, works from home as a software engineer, and drives a 2014 Toyota Camry that he paid off years ago. The car has 95,000 miles on it, and according to Kelley Blue Book, it has a private party sale value of about $8,000. He uses it for groceries, taking his kids to soccer practice, and the occasional weekend trip. He's financially stable. He has a robust 6-month emergency fund, so if he had to, he could write a check for $8,000 to buy a similar car without derailing his family's finances. It would sting, but it wouldn't be a disaster. David is in the gray zone, the sweet spot of confusion for most people. He has no lender forcing his hand. He can financially absorb the loss of his car. So, should he pay for full coverage? This is where we can introduce a powerful rule of thumb that many financial advisors use. The 10% rule. The rule is simple. If the annual cost of your comprehensive and collision coverage is more than 10% of your car's cash value, it might be time to consider dropping it. Let's do the math for David. He gets a quote and finds that liability only will cost him $500 per year. To add comprehensive and collision with a $1,000 deductible, the total premium jumps to $1,200 per year. That means the full coverage portion, the part that protects his car, costs him $700 annually. Now we apply the 10% rule. His car is worth $8,000. 10% of $8,000 is $800. Since his cost for the coverage, $700, is less than that $800 threshold, keeping full coverage could still be a reasonable financial decision. He's paying $700 to protect an $8,000 asset. But it's close. Next year, his car will be worth less, maybe $7,000, and the premium might stay the same. At that point, the math might flip. This is where David's personal risk tolerance comes in. Is he the kind of person who would rather pay a predictable $700 per year for the peace of mind that a major repair or total loss is covered? Or is he the kind of person who would rather save that $700, bet on himself as a safe driver, and accept the risk that he might one day have to cover an $8,000 loss from his savings? There is no single right answer here. It's a personal financial and psychological decision. If he chooses to drop full coverage, he is effectively self-insuring his car. He's accepting the risk himself in exchange for a lower premium. Given his strong financial position, this is a perfectly valid choice. It's a calculated risk. Finally, let's meet Maria. Maria is 62. She's a retired schoolteacher who drives a 2005 Honda Civic with 180,000 miles on it. The car is mechanically sound, but it's got its share of dings and scratches. His private party value is, on a good day, maybe $2,000. Maria has a healthy retirement nest egg and a significant emergency fund. She drives fewer than 5,000 miles a year, mostly to the library, the grocery store, and to visit her grandkids. For Maria, the decision is crystal clear, but in the opposite direction from Sarah. Let's run the numbers. Her liability-only insurance is incredibly cheap, maybe $350 a year due to her age, driving record, and vehicle. Adding full coverage, even with a high deductible, would add another $500 to her annual premium. So, she would be paying $500 every year to protect a car that is only worth $2,000. In just 4 years, she would have paid the insurance company the full value of her car in premiums. This makes absolutely zero financial sense. Maria can easily afford to replace the car out of pocket if it gets totaled. The $2,000 loss would be an inconvenience, not a financial crisis. She is the perfect candidate for liability-only insurance. The purpose of her insurance policy is not to protect her old, high-mileage car. The purpose of her insurance is to protect her assets, her retirement savings, her home, from a lawsuit if she causes a serious accident that injures someone else or damages their expensive new car. She needs high liability limits to protect her nest egg. But paying to protect her own vehicle is a waste of money. She has wisely chosen to self-insure the value of her Civic. So you see 3 people, 3 different stages of life, and 3 radically different but equally correct insurance decisions. Sarah with a new finance car and limited savings, for whom full coverage is an absolute necessity. David, in the middle, with a paid-off car of moderate value and a healthy savings account, for whom the decision is a calculated balance of cost versus peace of mind. And Maria, with an old, low-value car and substantial assets, for whom full coverage would be a financial mistake. These aren't just stories, they are frameworks. You can place yourself on this spectrum. Do you have a loan? You're a Sarah. Is your car paid off but still holds significant value relative to your savings? You're a David, and it's time to do the 10% rule math. Is your car's value less than what you could comfortably pay out of your emergency fund? And is the premium a significant chunk of that value? You're a Maria. The question isn't just, what's my car worth? It's what would happen to my life if that car disappeared tomorrow? It's a question of cash flow, assets, and debt. It forces you to look at your car not just as a machine that gets you from A to B, but as a financial asset or liability within your larger financial picture. Understanding this distinction is the key to making a smart choice. But even after you've made the perfect choice on paper, there are hidden traps and psychological biases that can cost you thousands. Let's talk about the invisible forces that dictate your choice, the ones that have nothing to do with math or logic, and everything to do with how your brain is wired. The first and most powerful is something called anchoring bias. When you get your first insurance quote, that number, let's say it's $200 a month, becomes your anchor. Every other quote is now judged against it. So when another company quotes you $180, your brain doesn't think, is $180 a fair price for this coverage? It thinks, wow, a $20 discount. That's a great deal. The insurance company just anchored you high to make their real price feel like a bargain. They set the frame, and you started playing inside their box without even realizing it. You stopped asking if the box itself was in the right place. This is why you must ignore the first number you see. It's not data. It's a psychological tactic. Your first step should never be to get one quote, but to get 5. From different companies, different agents. Only then do you get a true sense of the market, and you create your own, more accurate anchor based on an average, not on a single company's opening bid. The second trap is even more insidious. Loss aversion. Behavioral economists have proven that the pain of losing $100 is psychologically twice as powerful as the pleasure of gaining $100. We are hardwired to avoid loss at all costs. Insurance companies don't just know this. Their entire business model is built on it. They sell you peace of mind by amplifying your fear of loss. This is the engine behind the low deductible trap. Let's say you have 2 options. A policy with a $500 deductible that costs $150 a month, or a policy with a $1,000 deductible that costs $120 a month. That's a difference of $30 a month, or $360 a year. Your loss-averse brain screams, $1,000. I can't afford to suddenly pay $1,000. I'll take the lower deductible. Feels safer. But you're not doing the math. You are paying a guaranteed $360 extra every single year to avoid the possibility of paying an extra $500 if you have an at-fault accident. If you go 2 years without a claim, you've already paid $720 extra to protect yourself from a $500 risk. You've paid more in premiums than the benefit you would have received. You lost money to feel safe. The rational choice, if you have a healthy emergency fund, is to take the higher deductible, bank the savings, and effectively self-insure for that small, manageable amount. You're betting on yourself, and statistics say that's usually a winning bet. Then there's the flip side. Optimism bias. The "it'll never happen to me" syndrome. This is what leads smart people to choose dangerously low liability limits. You're a great driver. You've never had an accident. You don't text and drive. So you think, why would I need $300,000 of liability coverage? The state minimum is $25,000, that should be enough. You feel that because you are careful, you are immune. But your policy isn't just for when you make a mistake. What if you hit a patch of black ice? What if a deer runs out and you swerve into another lane? What if your brakes fail? Over 6 million car accidents happen every year in the United States. The vast majority of those people woke up that morning thinking they were great drivers and that it would never happen to them either. Optimism bias is a comforting lie we tell ourselves, and in the world of insurance, it's a lie that can lead to financial ruin. You aren't insuring your driving skill. You're insuring your net worth against a single moment of bad luck. These biases lead us directly into the most common trap of all, the loyalty penalty. You've been with the same insurer for 10 years. You're a valued customer. They even send you a holiday card. But each year your premium creeps up. 5% here, 7% there. It's small enough that you don't question it. You're comfortable, you know the company, and shopping for insurance is a hassle. This is called status quo bias. We prefer for things to stay the same. Insurance companies exploit this mercilessly. They know that acquiring a new customer is expensive, so they offer huge introductory discounts to lure people in. To pay for those discounts, they rely on raising the rates on their long-term loyal customers who they bet are too complacent to shop around. The very act of being loyal is costing you hundreds, maybe thousands of dollars over time. The single most effective way to save money on car insurance is to destroy this loyalty. Every single year, or at the very least every 2 years, you must shop for new insurance. You have to force them to compete for your business as if you were a brand new customer, because that's when you have the most power. And finally, let's talk about the biggest psychological trap, one that's hidden in the title of this very video. The term full coverage itself. It's a brilliant piece of marketing, but it's a complete myth. Creates a false sense of security. When an agent tells you you have full coverage, you stop asking questions. Your brain hears full and assumes it means total or complete. You think you're protected from anything that could possibly happen, but you're not. Full coverage is just an industry slang term for a policy that combines liability, collision, and comprehensive. It does not automatically include other critical protections. Do you have a rental car reimbursement rider? If not, and your car is in the shop for 3 weeks after an accident, you're paying for a rental out of pocket. That could be over $1,000. Is that covered? No. Do you have custom wheels or a high-end stereo system in your car? Your standard collision policy likely won't cover those aftermarket parts, unless you have a specific custom equipment rider. Are they covered? No. What about gap insurance on your new car loan? If you total the car, your comprehensive coverage will only pay you the car's current market value, which could be thousands less than what you still owe the bank. Without gap insurance, you'll be writing checks for a car that no longer exists. Is that covered by your full coverage? Absolutely not. The term is a trap designed to simplify the sale and make you feel secure, while leaving massive holes in your actual protection. The only way to beat it is to ignore the term completely. Never ask for full coverage. Instead, you must build your policy piece by piece like an expert. You start with the foundation. I need bodily injury liability of $250/500 and property damage liability of $100. Then you add the walls. I need collision coverage with a $1,000 deductible and comprehensive coverage with a $1,000 deductible. Then you look at the extras, the windows and the doors. Do I need a rental reimbursement rider? Do I need a gap insurance rider? You must be the architect of your own policy. By understanding these traps, anchoring loss aversion, optimism bias, the loyalty penalty, and the myth of full coverage, you shift the power dynamic. You're no longer a passive customer accepting the terms you're given. You become an active, informed consumer who understands the game better than the person trying to sell you the policy. You can now navigate the system with your eyes wide open, sidestepping the psychological pitfalls designed to separate you from your money. You've learned how to pick the right type of coverage and how to avoid the mental traps that lead to bad decisions. But there is one final, crucial element. It's the strategic process that brings all of this knowledge together. A step-by-step method that will guarantee you find the absolute best rate for the exact coverage you need. It's the master move that separates the amateurs from the pros, and it's how you'll truly take control of your auto insurance once and for all. Okay, this is it. The single most important part of this entire process. Forget everything you think you know about buying insurance. We're not just shopping around. We are executing a precision-guided strategy to force the market to compete for your business, not the other way around. This is the 5-step market pressure method. Step 1 is called building your dossier. You cannot go into a negotiation unprepared. Before you make a single phone call or click a single link, you need to assemble your intelligence. First, pull up your current insurance policy's declaration page. This is the document that lists every single coverage, every limit, and every deductible you currently have. You need to know this information cold. What are your liability limits? 25/50/25? 100/300/100? What are your comprehensive and collision deductibles? $500? $1,000? Do you have rental reimbursement? Roadside assistance? Know your current state exactly. Next, gather your personal data. You'll need the vehicle identification number, or VIN, for every car you want to insure. You'll need the driver's license number for every driver in your household. You need an accurate estimate of the annual mileage for each vehicle. Don't just guess. Check your last oil change receipt or your car's service records. Is the car used for commuting, pleasure, or business? Do any drivers have recent tickets or accidents? You need to have all of this information written down in a single document or on a piece of paper in front of you. This is your ammo. Going into this process without your dossier is like walking into a final exam without a pencil. You're setting yourself up for failure. Step 2 is the blueprint. Based on everything we've discussed in this video, you are now going to decide in advance the exact coverage you want. This is non-negotiable. You are building your ideal policy on paper before you ever speak to an agent. You're going to write down, I want 100/300/100 liability coverage. I want a $1,000 deductible for both comprehensive and collision. I want rental car reimbursement coverage of $40 per day. I do not need roadside assistance because I have it through my credit card. You must be this specific. Why? Because this blueprint becomes your control variable. It's the only way to compare apples to apples. When you start getting quotes, insurance agents are masters at subtly changing the variables to make their price look better. They might quote you a lower price, but they've secretly dropped your liability limits or jacked up your deductible. By having your blueprint written down, you control the conversation. You are not asking them what you should get. You are telling them, this is the exact policy I am buying. Please provide me with a price for these specific coverages. This single action shifts the entire power dynamic from them to you. Step 3 is the multi-pronged attack. We are going to systematically canvass the entire market in the most efficient way possible. You're going to attack this on 3 fronts simultaneously. Front 1. Contact an independent insurance agent. These are agents who don't work for one single company like State Farm or Allstate. They represent dozens of different carriers. Their job is to take your blueprint and shop it to all of their partner companies to find you the best rate. This is a massive leverage point because with one phone call, you're getting quotes from 10, 15, even 20 different insurers. Front 2. Go direct to the captives. Some of the biggest insurance companies like Geico and Progressive don't typically work with independent agents. They sell directly to you. So while your independent agent is working their magic, you need to go online or call these direct-to-consumer giants yourself. Again, you use your blueprint. You enter the exact same coverage you gave the independent agent. Front 3. Use a major online comparison tool. Think of sites like the Zebra or Insurify. These can be a good way to catch any smaller or online-only insurers that the other 2 fronts might miss. A word of caution here. Some of these sites are primarily lead generation tools, so be prepared for some follow-up emails or calls. But they are a valuable part of a comprehensive search to make sure no stone is left unturned. By using this multi-pronged attack, you can effectively get quotes from 30 or more companies in just a few hours of focused work. You are carpet bombing the market with your specific needs. Now, you wait for the results to pour in. Step 4 is the leverage play. This is the masterstroke. After a day or 2, you'll have a stack of quotes. You're going to identify the single lowest legitimate quote you received for the exact coverage on your blueprint. Let's say your current insurer, Company A, is charging you $2,000 a year. But you found Company B is offering the identical policy for $1,400. That's a $600 difference. The amateur move is to just switch to Company B and call it a day. The pro move is to make one final phone call. You call your current insurer, Company A. You get a representative on the phone and you say the following calmly and politely. Hi, my name is, your name, and my policy number is, your policy number. I've been a loyal customer for a number of years. My policy is up for renewal and I've been doing some comparison shopping to ensure I'm getting the best rate. I've received a quote from another reputable insurer for the exact same coverage I have with you, and their annual premium is $1,400. That's a $600 savings. I really like being with your company and I prefer not to switch. My question is, can you do anything to match or get closer to that rate so I can stay with you? And then you stop talking. You have just professionally and respectfully cornered them. You've demonstrated you're a savvy shopper. You've given them a specific, competing offer to counter. And you've expressed a desire to remain a customer, which is a powerful psychological tool. Insurers spend a fortune acquiring new customers. It's far cheaper for them to give a discount to keep an existing one. 9 times out of 10, they will magically find a new discount you suddenly qualify for. They might not match the $1,400 exactly, but they might come back with $1,500. Now you have a choice. Save an extra $100 and switch, or stay with the company you know for a $500 annual savings. Either way, you win. This leverage play alone is worth the entire effort. Finally, step 5 is the annual reset. This is not a one-time trick. This is your new standard operating procedure. Your life is not static. You might buy a new car, move to a different zip code, get married, or improve your credit score. All of these things dramatically impact your insurance rates. Furthermore, insurance companies are constantly changing their own pricing models. The company that was cheapest for you this year might be the most expensive next year. Set a calendar reminder for 1 month before your policy renews every single year. And every single year you run this 5-step play again. Build your dossier, update your blueprint, launch the multi-pronged attack, execute the leverage play, and lock in the best rate. It might take you 2 or 3 hours once a year, but for a potential savings of hundreds, even thousands of dollars, that's the highest paying job you will ever have. This is how you stop being a passive price taker and become an active price maker. This is how you transform auto insurance from a confusing, frustrating expense into a problem you have solved. You now understand the difference between liability and full coverage. You know how to choose your limits and deductibles to fit your personal financial situation. And now you have a repeatable, battle-tested system for guaranteeing you never ever overpay for it again. You are in control. The choice between third-party and full coverage isn't just about protecting your car. It's about protecting your entire financial future. And by taking this knowledge and applying it, you're not just buying a policy, you're buying peace of mind, security, and financial freedom.